President Trump and Bill Pulte are pushing for 50-year mortgages to make homes more affordable. What it does is it extends the term to 50 years rather than 30 to lower the payments with an aim to help first-time buyers buy a home with the affordability crisis everybody's been dealing with. But is it really building wealth or delaying the pain? Today, we're going to run these numbers transparently. And actually, at the end, I'm going to share with you my philosophy on how to fix the affordability issue in America for those looking to buy homes. Hey, I'm Ray from Mortgage Meister Group. We are a veteran-owned independent broker helping you navigate real estate transparently and honestly. So let's recap. 50-year mortgage aimed to lower payments about 10 to 15% less, would qualify more buyers, would address affordability crisis. With the rising inventory, prices being steady, and rates aimed to stay about the same in 2026. But those on the other side would say that there is a huge upfront interest buildup, slower equity, and potential for those to get in trouble if not careful. Let's use a realistic example of $600,000 on a home loan, a standardized 30-year fixed rate at say 6%. Now I'm going to add a premium on the 50 because if you have a 15-year fixed, those that look at rates know you get a lower rate on a 15-year term. So let's say 0.5% premium. So 6.5% on that 50-year mortgage. The savings honestly will end up just over $200 per month. Is that worth it for you? Over 50 years, you're going to pay over $700,000 more in interest. It's like buying that house twice and getting one home out of the deal. With a 30-year fix, you will chip away more principal in, say, the first 5 years. Say $42,000 in the first 5 years compared to that 50-year fix at, say, $9,000, which slows your wealth growth big time. The important thing about that to understand is that the problem becomes when you look to refinance, when you look to sell, because life changes. If in those first 5 years, you've only paid down $9,000 in principal, you're forced to rely on appreciation to be able to have additional equity and or personal savings to be able to buy that next house. If appreciation weren't to happen and it went flat, you need higher wages to have money to buy the next home, with the forecast that home prices will go up with the inventory crisis we have in America. Is it savings? I don't see it as that. I don't see it as building wealth. I see it as extending servitude to the lenders. Slower equity makes it harder to sell, makes it harder to refinance. When life changes and life is dynamic, what would you do in that situation if you had a 50-year fixed? In the shorter term, you could look at things like an adjustable rate mortgage, like a VA and FHA have very responsible adjustable rate mortgages. Take a look at the videos that I have on this topic. They are not the adjustable rates from 2008. Maybe down payment assistance to keep your savings liquid, or buying smaller and build equity faster that way. So the 50-year mortgage may sound innovative, but the math shows it's not a smart bet and a wealth killer for most. Always run your own scenarios, but as I mentioned to you, I was going to share my philosophy on how to help the affordability crisis. Look, outside of America, a fixed rate mortgage does not exist. Adjustable rate mortgages are pretty much the standard in places like Canada or Europe. And over time, what ends up happening is you renegotiate the adjustable rate. Whereas in America, they adjust on you or you're forced to refinance. So renegotiating that adjustable rate would help keep those rates lower, help you paying more towards the loan, less towards interest, and keeping those payments affordable. So my opinion is reimagining the adjustable rate mortgage in America rather than a 50-year term is a smarter way to help affordability here. If you like this type of content, make sure to subscribe for transparent ways to build wealth through real estate. Thank you so much.